Hi folks, I'm Jeff Camarda, and frequently I'm asked, can active investors really beat indexing? Indexing seems to be, the world has changed and this time it's different. Indexing is here to stay. So over the past several years, much hay has been made about the superiority of indexing versus active investing, to the point where many investors, with the encouragement of the media, believe that even good advisors or portfolio managers can't consistently pick stocks that beat the market, and that indexing is the way to go. Indexing, of course, is betting on an entire market like the S&P 500 instead of trying to find the best stocks within that market. You'll get some stars and some dogs, but on average you'll do as well as the market by definition, and that's as good as it gets for most folks, so stop trying to win and just accept it. Of course, that's the Kool-Aid. Of course, this is easier to live with in good markets than bad. Now, certainly market performance in the years since the 2008 crash has lent credence to this notion, with a swiftly rising tide of a surging U.S. market bounce back from the incredible lows of the meltdown, lifting stocks of nearly every stripe and color to repeated records. However, the tide is wont to change, as Camarda thinks it maybe has now, and investors who rely on recent trends to chart future paths are often disappointed, sometimes horribly disappointed. And yes, 10 years is still pretty recent as far as market long-term forces and rhythms go. Now, indexing is currently the raging fashion, but the world seems to change as soon as everybody knows something, like the index myth that all stocks are created equal. Camarda as a firm has always held that careful analysis can uncover superior opportunities. Similar shares for cheaper prices, better companies for similar prices, shares which are rising faster due to institutional demand, and so on, which can translate into better investment returns. A good analogy is rental real estate, of which I'm an avid fan, where it's not unusual to find virtually identical rental houses, except for the paint and a hole in the roof and so forth, but the same basic house, the same area, same size, same construction, same rental rate, for 40% less than others. One for 100, one for 60, with a little bit of love, worth 100 pretty quick. Valuable sellers, ignorant, desperate, or hopelessly optimistic, misprice wares for sale all the time. They overprice, they underprice, they just don't know. So we firmly believe that applies just as much to stocks, I think, as to real estate. And we firmly believe that hard work and research can really pay off in shopping for real estate, cars, stocks, and Camarda endeavors to do this in the portfolio it creates and manages for its clients. From this perspective, that it seems obvious that some company stocks are more attractive than others. The current fashion of indexing may seem unusual. When one considers the academic underpinnings, it seems quite bizarre and most contrary to common sense. It's based on something called the rational expectations hypothesis out of the Chicago Booth School of Business, on which a lot of stuff came out there, but on which the efficient market hypothesis, and by extension indexing, is at least partially based, holds that markets comprise pretty exclusively of smart, logical, informed, intensely interested human beings, definition of markets, they quickly and accurately process all available information to properly price current and future prices. In other words, the price is always right. You can't outsmart the market. You can't outsmart the market, and trying to get a better deal or expecting one company's stock price to offer more value than another is not really possible. Hence, investing in the entire market rather than trying to pick individual winners is the surest, simplest path. In a nutshell, the theory presumes that all people have the same intelligence, information, interest in spending their limited time pondering investments, and that the actual time to do it is available to them if they really care. Working together, the market unfailingly finds the right price for all things, and market disruptions or opportunities are impossible. And that's the efficient market hypothesis on which, from rational expectations, that is really the core of the indexing concept. Newsflash, by the way, folks, perhaps some people make stupid decisions. They get caught up in emotion, they don't have the information or the time, and that others can profit from. You think that might happen? To some folks, this premise has always seemed crazy. including me. Market players are as different as athletes, the ones that make professional teams, the ones that play in backyards, the ones that fall down, the ones that don't fall down, the ones that are fast and slow can jump. And sometimes they're so emotional, human beings, human investors, as to lose all reason and jump off the cliff with the rest of the herd. Sometimes even the entire world gets it wrong and bubbles and crashes happen. 2008 brought pause to even the most diehard of the rational expectations crew, and the academic world is slowly reframing its theoretical outlook. The indexing approach seems to be largely a hangover of a tattered and limping theory that one, like other fashions, that may continue on sheer momentum long past the time when the world should learn and move on. Speaking of fashions, you know why the lower button on men's vest is often left unbuttoned? It's considered gauche to button the lower button. You know why? So the vest doesn't bunch up when a gentleman is riding a horse. That's the reason. Talk about hangover fashions. And it's somehow ironic, I think, that indexing continues, even in the wake of 2008, to increase in popularity and correctness. Just because the average investor's market returns must, by definition, be some function of average market returns does not mean there will not be scads of winners and losers who do better or worse than the averages, or that it's unreasonable or improbable to shoot for the winner's circle. Not only does Camarda believe that active management, doing research and analysis to try to uncover superior profit opportunities over time, should prove to be more profitable, but that the current market cycle will especially favor exceptional stock picking. I think that's going to be true for at least a few years. Camarda uses a variety of methods to target exceptional opportunities, from technical or charting analysis to pouring through companies' books to look for cheap, mispriced stocks that have strong profits, businesses, or asset structures. We'd love to tell you more about it and are confident that in the months and years ahead that they will prove to be very gratifying for active investors like Camarda clients using Camarda's approaches, but quite disappointing for those holding to the passive indexing past and maybe leaving one button undone needlessly just in case. Well, that was a long one. If you stayed with us to the end, thanks so much for watching. I'm Dr. Jeff Camarda. Go forth and profit. Until next time, thanks for watching. Bye-bye.